Welcome everybody to the Grit Group financial year-end 2021 results conference call. On the call today, we'd like to welcome Bronwyn Knight, the Grit CEO, and Leon von Motel, the Grit Group CFO. We'll go through the slide pack shortly with a couple of the sort of key messages and key highlights, just some order of business for the day. We'll try and get through those in about 30 to 35 minutes, after which we will open for Q&A. If you have questions, please feel free to put them in the chat box during the presentation, and we'll address those. Alternatively, there's a raise your hand function on Zoom, so please raise your hand and our moderator will come to you in the Q&A section. So without any further ado, let me hand over to Bronwyn and to Leon to kickstart the presentation for today.
Thanks, Darren, for the introduction. And on behalf of Leon and myself, I would just like to welcome you to the Grit year-end results presentation. The intention today is to give you an oversight of the world that we've had to navigate, specifically under the COVID environment that we've seen ourselves over the last somewhat probably 20 months. And the intention is just to give you a good feel for what management has actually done, and the interventions both that have been within our control and aspects that have been out of our control, and where we're going to be navigating the business going forward. So just to remind everybody, Grit Real Estate is obviously fundamentally driven by key factors. So the investment strategy is that we back strong tenants across the African continent to become their real estate partner of choice. We transact in hard currency. We are multi-geographic, so have access and exposure into North, West, East, and SADC Africa, and multi-asset class, very focused on the strong tenant counterparty aspect. The Grit business model, which is a cradle-to-grave real estate solution, allows us to optimize on the entire value chain of real estate. So property management, facilities management, development management, the access to developments through our strategic partner, Greer, and the ability to operate existing and access pre-funding ability into developments. So just really around where are we invested today? So a huge reminder that the African continent is obviously a large place. We do not invest in South Africa. We are looking for hard currency conglomerate tenants that we can support across Africa. So this will give you a good understanding of where we have access across the geographic presence. And then where we are actually sitting, where we are currently positioned today, is that what we have tried to do is really navigate what we've seen as a very interesting trajectory under the COVID period. And under the ambient of that, from a performance perspective, some things have gone tremendously well and other aspects have been tremendously challenging. So where we're going to sort of touch on from today is the operational highlights. What we have seen is that we have seen vacancy levels recover. We have seen strong collection rates, and I'll go into a little bit more detail with that. Our treasury team has extended a number of fees from a balance sheet perspective, debt perspective. We have seen strong income stabilization, growth in operating income, and then we've seen some challenges around valuation specifically, which has put pressure on the loan to value, which I'll go into a bit more detail now. So again, just really the key aspects of the business of Grit and what we have obviously as an operational team really focused on the last couple of months, and where we will continue to focus on into the future, which is all about balance sheet strength. So the portfolio has proven to be fairly resilient, with just under 60% of the portfolio really performing exceptionally well under the ambient of COVID. The operational team has done an exceptional job with collections of over 92%. We have seen pressure on retail, hospitality, one of our specific assets under corporate accommodation, Vale, which I'll touch on now. What we have seen is we've seen challenges around loan to value, and getting very close to covenants, which is a direct correlation and impact of the valuation pressure, specifically under retail and hospitality. And under the ambient of that, what we have done is, as a board, is we've looked at the balance sheet and we've said, how do we get loan to value to recover? One is the aspect of dividends, which I'll go into the dividend trajectory and what we're looking at from a dividend perspective and protecting the balance sheet. The other aspect is the ability for us to recycle assets. You would have seen an announcement in our last market update around ANFA specifically, one of our retail assets, and the ability to recycle that asset. And then we have obviously launched a preference note strategy, which we have also announced recently under the ambient of the Orbit transaction. This for us is really an important slide. And the importance of this slide is really around looking at the Grit business. Now, the Grit business is invested in commercial real estate across the African continent. You will see sectors like light industrial, office to an extent, corporate accommodation, except for our Vale asset, which I'll touch on specifically, have remained very resilient. Where you have seen pressure is you've seen pressure on retail and you've seen pressure on hospitality. What we have, however, seen is that we've seen the NOI of the business still be able to grow by 3.5%, which means that over a period of time, we will see recovery of NOI on retail and we will see valuation recovery on retail specifically. So under the corporate accommodation, and Darren, if I can just ask you to hold on this specifically, we have seen a direct impact on Vale in Mozambique. Vale has announced quite publicly that it will be disposing of its concession in that jurisdiction. What that has done is that the valuers have taken a very prudent approach on one, the rental levels, even though we've got 3 years left on that lease, the rental levels at the exit of that lease and what will be coming in from a rental perspective. So we have seen somewhat a $15 million reduction on that specific asset, which gives you a correlation to we sitting at about 5% on our NAV. So you'll see that the impact of our valuations and the impact of raising liquidity facilities over the period of COVID, specifically for the hospitality sector, which I'll touch on now, has seen that LTV trajectory go up to levels that we as a board are aggressively looking at initiatives on how we actually reduce the loan to value. But this is a very good slide because it actually gives you the indication of performance per sector and where we are seeing pressure, specifically the retail sector. So Darren, if I can ask you to move to hospitality. Hospitality constitutes about 25% of the Grit portfolio. As we're all aware, under COVID specifically, Mauritius was in full lockdown from March of 2020 and has really only officially opened up its borders from the 1st of October. We have had to give almost no rental concessions. However, we've had to assist these hospitality tenants on cash flow deferrals and cash flow reprieve. What that has meant is that we have had to assume liquidity facilities, which has increased our loan to value to be able to support these tenants. However, from the 1st of October, both Beachcomber and Lux, also under the support that they received under the Mauritian government, MIC and support funding, have resumed rentals in full. We see Club Med now from the 1st of October, that hotel will be reopened. There is resumption of international flights around Senegal specifically, and we see rentals resuming from the 1st of December. So whilst the last 18 months has been a cash flow pressure on the group, there have been little rental remissions given to these guys, and now we see an almost full recovery of them having the ability to repay their rentals. Now, I've spoken a lot about a loan to value because I think from a board perspective and from a Grit perspective, and obviously from a management team perspective, the loan to value is one of the key fundamental aspects that we are currently managing. The ability to manage loan to value from where we've seen this press up to over 53%, driven by the valuations and driven by the pressure that we've seen on valuations. Just a reminder that our group overall covenants from a banking perspective sit at 55%. So we believe that what's sitting in the valuations today is a very, very conservative approach on valuations. So we, whilst close to the 55%, have not breached any covenants. But how do we get that loan to value down? And how do we get it down as a board? So the aspects that we are currently working on is asset recycling. We've committed to recycle approximately 20% of our asset value over the next 2 to 3 years. One of those aspects is we have officially announced the disposal of ANFA, which will be disposed at book value, at 30th of June book value. The transaction is currently under due diligence. And the idea is, one, we do want to reduce our retail exposure. This was even a pre-COVID strategy of the group. And secondly, the ability to recycle the specific asset. The other aspect that we have looked at over and above asset recycling is the ability to raise preference notes. Preference notes are recognized, and we have the ability to recognize these as equity. We announced a very, very good transaction, which was yield enhancing for Grit under the ambient of a sale and leaseback transaction in Kenya on a light industrial development, plus existing warehousing. We have entered into a 25-year lease. We have the ability to take on preference note money into this particular transaction. It is a US dollar hard currency. As I mentioned, it is earnings and NAV enhancing to Grit, and brings on 2 really strategic new shareholders, well, equity holders under the ambient of both Ethos and Blue Peak under the preference note. And furthermore, what it does is it gives us a strategic alignment with the IFC, which is the International Finance Corporation. The IFC is fundamental capital for Africa. It is DFI money, it is long-term capital, and we have been successful in securing a senior debt facility and undergoing a 4-month due diligence with the IFC, which was signed off, and they were extremely complimentary around the governance structures of Grit. So the Orbit transaction brings us a very good tenant, a long-term lease, a dollar lease, the IFC relationship, and then the preference note structure, which is yet again another ability to reduce the loan to value. The other aspects around loan to value, which I'll touch on further, will obviously, as I've mentioned already, valuation recovery, and then I will get into what we're going to be doing from a dividend perspective. Just really around the ambient of the portfolio overview, what is really, really important, and again, it's around the operational strength of the team. And just to highlight, Grit is the only real estate platform across Africa that has a cradle-to-grave real estate solution. What that means is that we are able to successfully and operationally manage the portfolio. And that has a direct correlation to the performance that we've seen. So we have taken, as of December, our vacancy rate was over 8%. We've taken that close to under 6%. So the team has done a really good job under COVID and some of the recoveries around filling up those vacancies. As I had mentioned earlier, one of the other key aspects is the collection rate and how much is actually being collected under the operational performance. And really just going under the ambient of the actual operational functionality of the team. So, you know, the main aspect is that 70% of our revenue to date comes from 15 tenants. And one of the big things under COVID is to make sure that these tenants have longevity and that these tenants are secure within the Grit portfolio, because ultimately their success is our success, and we are obviously getting their rental income. So this is really, really important from this perspective. So really, before I hand over to Leon from a financial overview perspective, just a quick summary: operational performance, vacancy take-up has been good, collections has been good, we've seen revenue grow, we've seen operating costs being reduced, we've seen a somewhat, which Leon will touch on, 15% reduction in administration costs. So the operational semantics of the Grit business are strong. And on that note, Leon, if I can hand over to you, please.
Thanks, Bronwyn. As Bronwyn alluded to, I mean, there's been a lot of things that we've been able to control, and all the items that we have been able to control, I think on behalf of myself and the board and Bronwyn, we're very thankful to our staff for really driving this through. Specifically on your cost savings and cost assumptions, there's been some really significant savings. In total, nearly $6 million off of our operating costs versus the last year. And this ranges over the administrative costs as well as the operating costs in the buildings. This is particularly pleasing because there was also additional costs during this year for the specific hygiene requirements for COVID period, as well as some maintenance which couldn't be happening in the last financial year due to the COVID shutdowns, which needed to be caught up this year. I think the key highlights for us is obviously the administrative cost reduction of 31%, of which 15% is on the ongoing fees. Collection rates, which is the actual amounts collected on the debtors, is 92.5%. This includes the impact of the write-downs or the deferrals that we've had to provide for the tenants. On a monthly basis at the moment, we're collecting more than 100% of our billed income, which is now showing the actual collections of the deferrals that have been granted. And this is particularly pleasing going into the future. In terms of the items which I just wanted to highlight is just the impacts which we've seen on our distribution per share, our EPRA earnings per share and adjusted EPRA earnings per share. They were impacted by a number of items. Obviously, there's the 29% drop that we've seen in the NOI on the retail side, which is driven by vacancies and concessions provided to tenants. In addition, there's been some write-offs of debtors balances, and we've been pretty ruthless in terms of the impairment charges that we put through to ensure that the numbers presented are truly collectible. What we've also seen during this year is the full year impact of LLR portfolio coming on. And you'll see there that a considerable amount, LLR portfolio is doing significantly well. They've had another 5 acquisitions within there and with more acquisitions to come. The Greer portfolio, although this has been in the development phase on a number of assets, 3 of them have completed very recently. And we should be seeing the actual impact now of those revenue streams coming through after a long construction period, particularly the US Embassy Housing Compound in Ethiopia, as well as the data center in Nigeria. The other items just to mention is that our results have obviously also been impacted by the 2 sales that we've had during the year. We did a partial sale of Antwerp Place at the beginning of the year. We disposed of a 39.6% interest in that asset, and on Acacia Estates, we disposed of 26.6%. Going on to the net asset value movement of the group, you'll see that it's heavily impacted by the portfolio valuations. As Bronwyn mentioned earlier, these are going to recover over a period of time, specifically the retail where we've seen the biggest impact over the next sort of 12 to 24 months as the vacancies are filled and we start seeing recovery in the rental rates, as well as starting to see the impact of the turnover rentals that we've now included in a number of our contracts starting to come to fruition. I think one of the big highlights at the moment is looking at the Antwerp Place shopping centre. It actually has seen some very significant increases in footfall of late, and tenants are performing well on that basis, and we should be hitting some turnover rentals in that centre very shortly. Cash profits are still being achieved due to the actual collection ratios that we've managed to obtain. Just looking at the key highlights and stats, obviously the 53.1% LTV is a big concentration area for management, and the strategy to reduce that as quickly as possible. The income producing assets have reduced from 823 to 801. What we've also seen is the impact, obviously, of the COVID concessions that we've provided to our tenants, which has impacted our interest cover, which has come down from 2.4 to 1.8. This is expected to rebound fairly quickly once the COVID concessions, which are coming to an end, and we start seeing the highlights now of the improved vacancy stats coming through. Particularly important for us, obviously, is the ongoing asset management fee, seeing that drop from a 2% to 1.7%. And this is on the back of a reduced asset base as well due to the write-down of the fair values of these assets. This is quite a key focus for us, and just one thing to highlight is that while some of these cost savings are temporary in nature, approximately $1 million of these costs will relate to permanent cost reductions, and some of these relate to the simplifying of our listing structures. Having delisted off the JSE the prior year does reduce the burden of admin on having been listed on 3 exchanges. I think this is very key for us, is obviously looking at the debt expiry profile, specifically in an environment like COVID. We've been engaging with advisors and have appointed advisors now to look at a more permanent and longer term debt structure. As the portfolio has matured and as the size of the group has increased, we are now looking to enter a far more long-term structure in terms of our debt, with either the high yield bond being issued in the short term or a large syndicated debt structure. In light of that, what the Treasury team has focused on is to provide short-term extensions on all of our loans. You'll see the top graph showing there the debt expiry profile at year end, and the bottom graph which is showing the debt expiry profile as it stands today. This has been a significant achievement by the team, specifically under the ambience of COVID. And we look forward to having this as a far more longer dated debt structure in the near term. One pleasing thing that has occurred during the year is obviously our weighted average cost of debt, which has reduced slightly from 5.9 to 5.7%, which is also a key driver for our results at the end of the day. Quick update on the driving trading. Obviously, this is something that's still ongoing with management and the PIC, and we're looking to get resolution of that fairly shortly, and definitively within the next 6 months. Just in terms of capital commitments, obviously the looking after the cash is fairly significant. One of the items which we do need to clear in the next financial year is driving trading guarantee. In terms of Club Med, we've got some capital commitments there in terms of the phase 1, and then obviously the phase 2, which will start in April 23, following a delay due to COVID on the actual phase approach of that. Bolloré Warehouse, which is one of the areas where we've actually seen a slight reduction in our revenue, was a result of the redevelopment of this asset. We've now signed a new 5-year lease with Bolloré. They are taking up all of the new space at the moment, and phase 2 will be completed within the next month. We're very excited for the prospects of that asset going forward. The debt maturity in the next 12 months, this will be encompassed within our high yield bond or debt syndication program that we'll be launching shortly. And then obviously the one very exciting portion of our business is the amount of success that we've seen within our development associate career. They have now won a number of contracts on some very lucrative assets, which I think Bronwyn will touch on just now. And this has resulted in them making a final capital call on this, which is 17.9 million, the total investment we have there, which will total 35 million. And this capital injection would need to be required to maintain our equity stake in this structure. One thing that is very clear in Africa is partnerships are very important. However, the one downside of partnerships is when you're looking at a set of IFRS accounts, it's not always easy to see the impact of the various structures you own your properties in. We've now developed this slide to create a better understanding of the actual revenue streams and costs associated with all of our assets in partnerships or joint ownerships. So you'll be able to see a reconciliation from your IFRS income statement, taking out then your adjustments for the properties that are in joint ventures and associates, and then reducing that obviously by the amount of cash which is attributable to our smaller shareholders in certain assets, to give you a good economic interest income statement, of which you'll be able to see then the amount which is distributable. This is a very key slide to actually understanding grit, and is something that we'll be focusing on with our stakeholders to develop a better understanding of this structure. What you will see is our distributable earnings have dropped from 9.58 to 5.97, and we've withheld roughly the same amount per share as we did in the previous financial year, which is in line with the cash flows that we've had to now fund in terms of the deferrals granted to a number of our tenants. I'll hand over back to you, Bronwyn.
Thanks, Leon. So thank you, Leon, and thanks for that update. Just some further update around some of our pipeline developments and developments that we've actually announced. These particular transactions have been funded through either asset recycling initiatives or DFI-backed funding initiatives. So they sit within being fully funded under the ambient of GRIT. And what we have announced is we've announced the 2 healthcare projects backed by an international operator, 15-year leases, both currently being developed in Mauritius at the moment and actually well underway. I had mentioned the Orbit transaction and obviously the link now on the preference note, as well as the strategic relationship with the IFC. And then we were just, there was some redevelopment work that we were focused on. As Leon mentioned, one of our key partners and strategic sort of arms of GRIT is the Greer, the Greer investment itself. GRIT currently owns 20% of that. The importance of that is the fact that they have secured really, really good pipeline across the African continent, focused on asset classes, which is really a strategic shift for GRIT. Even pre-COVID, we had announced that we would want to be more involved in longer dated US Embassy, UK Embassy type real estate, light industrial type real estate. And obviously that has started with the commencement and acquisition of Orbit, data centers, the link to telecommunications across Africa. So the Greer portfolio, and as these assets are completed, they've just successfully completed American Embassy in Ethiopia. We see a very, very strong trajectory of NAV growth as this pipeline gets delivered. So the ability for us to access and increase our position in the Greer business is seriously under consideration. That particular team is a fully fledged 20-person strong development team, fully operational on their own, and the ability to run that concurrently along the ambient of a return perspective from GRIT makes absolute sense. So we're really excited around what that team is currently delivering and what their future pipeline looks like from a development perspective and NAV accretion perspective. The other aspect which is really key, and obviously being an Africa business, one of the main aspects to us and one of the key drivers is obviously sustainability, not just sustainability in our business model, but sustainability around our ability to leverage off this platform on an ESG perspective. And what does that mean in the life of GRIT? It means that we have identified 4 key tiers. Those tiers speak directly to our operational business across 8 African countries. We have made commitments under those tiers, under the ambient of carbon emissions, building efficiencies, which obviously directly speak to our hardcore real estate. Gender equality, obviously key, and obviously being a woman-led business, gender equality is absolutely paramount in our business. And I am very proud to say that we're one of the leading businesses from a gender equality perspective. And then local representation. Again, why this is so important, under COVID, we were locked down in our jurisdictions for over a year. The importance of having local people, GRIT employs over 100 people across the African continent, cradle to grave real estate solution, is the employment of local people within the ambient of each of these countries. So that is a critical pillar for the success of our business. So really just to provide a summary of where we are and what we have delivered and what we are committing to deliver. So it is not ideal, but the board has made a decision to not pay a distribution for this cycle. Why that is so important is that we need to be able to reduce the loan to value. That is a critical work stream, as I mentioned earlier. The balance sheet strength is a critical work stream. In summary, how do we do that? What is tangible today? Asset recycling is tangible today. Being able to see a valuation recovery, which will be a bit more medium term. The ability to have access into equity type instruments, preference notes. But what we want to target is we need to ensure that we get back into paying distribution. Once we have clearer trajectory to that 45% LTV, there we have a medium-term target of a payout ratio of 80 to 90% into the future. And as we see the hospitality sector recovering, as we see more cash flows coming, as we see the reduction of loan facilities and repayment of loan facilities, as we get closer to this 45%, we will be in a better position to now pay distribution. But distribution and payment thereof is a very, very key consideration, but really taken under the ambient of strengthening the balance sheet to not pay distribution now. So just really in summary, what I am driving, obviously as the CEO of this business and the management team with Leon and our C-suite around us, is that we will continue and have seen success on the operational performance of the portfolio, collection focus, cost control, vacancy management. The operational team has done an exceptional job over the last 12 months. The trajectory on the zero carbon pathway, sustainability is key, liquidity, balance sheet strength, 20% asset recycling. We have already started that with ANFA, which constitutes 8% of our asset value. Long-term debt, sustainability of debt structures. The next phase of Grit is how do we get longer dated debt? How do we consolidate our debt? What other types of debt are available to the Grit Group? And then a key focus on when and how we resume cash dividends, which is key for our business. So in summary, it has been a very, very challenging 18 months for the entire globe. We have all really been put onto the ground to really focus. We've done a lot of inward retrospection as a team, but we really believe that the portfolio of Grit and the business of Grit, which is really underlying real estate to multinational global tenants, cradle to grave solution, we have the foundation and platform to continue a very resilient, strong business into the future. So on behalf of Leon and I, and the board, and obviously the management team behind this, I'd like to thank you for dialing into our results presentation. And I think at this stage, Darren, if we can open up to questions, that will be great. Thank you.
Thank you. Thank you, Bronwyn and Leon. So as we've said, if you'd like to ask a question, please either type it up into the chat box function, or alternatively use the raise your hand function on Zoom. And so we'll pause for a couple of seconds to see if there's any questions. And maybe while we wait for a question or two, Leon, I think if you don't mind, maybe just go over the sort of near-term funding, specifically with the debt profile with Bank of China, and I think just some of the expiry profiles that people might be reading about in our accounts. Again, sure, if you don't mind.
I think one of the aspects that we've been quite keen to do for some time now is to provide a very long-term solution for our debt, rather than it being concentrated on a per asset basis as we've done historically. We've been speaking to advisors for a while now to put this solution in place, and it's something we want to launch in the first quarter of next year. One of the items which obviously is quite key is to then reschedule your debt to a sufficient period where you can have the ability to close this transaction out without putting undue pressure on your cash flows in the near future. To this end, all the facilities that were due within the next 18 months have now been rescheduled. The one facility which is currently still under negotiation is our Bank of China facility for our Zambian assets. This was one of the items which we are going to be focusing on to refinance either with Bank of China or through the new debt structure, which we'll be launching in the new year.
Great, thank you. Just a reminder, folks, if there's any questions, I think I've seen one pop up on the chat box. So the admin costs fell 31% to the 13.6, being 1.8% of asset value. So what is the sustainable ongoing admin cost base? And I think just to clarify there, Mark, the 31% is when you also include the transaction costs. So if we go back to the slide, I'll hand over to Leon to sort of explain this, but I think what we look at is that total ongoing administrative costs. which has fallen 15%. But maybe I can hand over to you, Leon. So what is sustainable? What do you think the long-term ratio and target should be? And again, what are the key drivers of that ongoing admin cost line?
Sure. So just to highlight, your total administration costs includes any transaction costs, which are generally once-off in nature and linked to specific transactions, whereas our ongoing administrative fee is really the running of the day-to-day business and the operations and the listings. What we've seen is a lot of temporary savings. For example, being in lockdown for well over a year, the ability to travel and access your individual sites has been limited. So those costs will return. It's very important that we as a senior management team are accessing these properties and spending time on the ground with our teams in country to make sure that we are generating the best returns out of these assets. What we do see is obviously our listing costs now being reduced, and in terms of only having 2 listings as opposed to 3 historically, and then some real cost savings in terms of just re-looking at salary levels and a bunch of other costs which were around advisors, etc. And the trajectory that we should be seeing is a permanent reduction to those cost levels of around $1 million per year.
Great, thanks, Leon. Why don't we go to a live question? So Monica, I see your hand is up. Lee, if you can just unmute Monica, or Monica, if you can unmute yourself, I'm not sure.
Oh, hi.
There you go.
Hi, morning, guys. Could you talk to us about sort of the cash position of the company? So I guess the key threats are one, sort of the covenants that you may come to a point where, I guess evaluations, something got written down significantly, there you would need probably the fix would be to top it up with cash so that you don't breach them. But just around the cash, and also you have commitments in terms of capex and other things that you do. So I understand that you're not paying a dividend because of the LTVs about where you'd like it to be. But in actual terms, how much cash there is or coming in? So I'm assuming that, next financial year, you moved in the right direction, or you hit the 45%, valuations went up. How from your projections on the cash that's coming in after taking in all the expenses or so on, what kind of, I know that you can't make projections on dividends, but just to give us an idea of the net cash that will be left and available for distributions.
Yeah, so maybe to touch on that, historically, our cash generations per month on average was circa $2.5 million a month. What we've seen now, obviously, with the impact of retail, that trajectory going into the future is difficult to predict right now, but it should recover to those levels over the next 2 years. What we are seeing in the interim, though, is all of the cash that hasn't been collected from our hospitality debtors is going to be collected over a period of time, starting already actually with the first payments just before year end, with some of our tenants returning to full payments very shortly, and then a period of recovering the deferred payments. So in terms of your monthly cash generation ability on a normal operating basis over the COVID period was between $1.5 and $2 million. And we see that returning to pre-COVID levels between the mix of 12 to 24 months.
And if I may follow up, you mentioned about sort of setting a target to 20% capital recycling. So I expect that means selling some assets and buying new ones. So how much of that is Amber Place? And any update on? I think you mentioned there was a 2 months period for the buyer to buy it. So whether I don't know if you can give us a sort of a likelihood of that completing. And other than that, what sort of you had in mind of disposing, and how that compares to the valuations? Do you think that would be a book or below, or it might be even above?
Thanks, Monica. I think I'll answer that one. I hope you will. It's good to chat to you. So maybe Leon, if you can just add in, of obviously what I left off, because there were a couple of questions that Monica asked on that. So the ANFA disposal contributes to about 8% of our asset value. So just to give you an indication, we saw a write-down of that asset for the June valuation now under the ambient. So the NAV that you see us posted just under the 103 actually includes the write-down book value. The asset is currently being disposed of at that book value amount. I am personally engaged in the due diligence with the potential acquirer, with my operational team. The due diligence and the process, which we feel underway, will be completed by the end of November. So should that be successful, hopefully we'll see agreements. There might still be suspensive agreements being signed this side of Christmas. But ultimately, that is the strategy. Now, if you remember, Monica, pre-COVID, actually, we had said that we want to reposition the portfolio and we want to reduce our retail exposure for various reasons. But again, COVID has demonstrated what portion of our portfolio is actually resilient. And retail continues to be complex for Africa. It continues to be complex from a management intensity perspective. And the bigger retail continues to be very complex. So we think that this is a really, really good decision to strategically dispose of this asset and recycle this capital within the ambient of what we're doing at the moment. Leon, is there anything else that you want to add on specifically on what Monica's asked? And hopefully, Monica, I've answered all of your questions.
Thank you.
Yeah, I think just to add to what Bronwyn says, I mean, the actual disposal of the asset would be fairly positive in terms of LTV. It is one of our high individual LTV assets. The impact of the transaction will impact it by roughly 1.3%. And then obviously you get to the deployment of cash. If you plow the actual cash into debt, or you actually utilize that for the acquisition of a different asset, which is more yield and enhancing. What the general rule of thumb in our business is, for every $10 million that you actually place into debt, you will see a reduction of your LTV by about 1.3%, whereas every $10 million that you deploy into a new yield enhancing asset would basically reduce your LTV by roughly 0.7%. So the real structure here is to reduce your debt in the short term to get that LTV, while creating this war chest to take advantage of really good opportunities as they present themselves in the short term.
If I can just add on to that, Leon, I think, so Monica, we'd expect to make announcements towards the end of November, early December on ANFA. The value of the asset there, you can see, is about $80 million. We obviously don't own a full 100% of that, but it will be circa 7 to 8% of the 20% we've indicated. As a management team, we are working on further disposals and again, would hope to make announcements in short course. As everybody would appreciate, Africa takes longer. It's not like Europe where you can announce it and there's a proper, there's a central property registrar that helps and gets things done speedily. Transaction volumes take time in Africa, which I think is why we're, don't want to overpromise, but we are certainly busy with a lot of things behind the scenes. Great. I think let's maybe move on to the next question. So maybe let's start on this one, Bronwyn and team. So the current share price is quite a substantial discount to the newly reported EPRA NAV, circa 50%. So does the company see good value in that? And personally, will management be buying shares? If you don't mind, Bronwyn, I'll start off the conversation by saying shareholders will notice that we have recently put in some approvals to increase our share buyback authorities. We've also very aligned with UK market principles, have sort of got the approvals to do issuance out of treasury shares. And I think on some suggestions from previous calls, effectively, now that we're out of blackout period, we can start implementing a treasury buyback program. So the mechanisms are in place. Obviously, the cash on our balance sheet might not necessarily be there yet with our LTV, but with that sort of structure in mind and the framework that has now been set up through the various shareholder approvals, let me hand over to Bronwyn and Leon to answer the question.
Yeah, so I think, I think the question is probably twofold. I think one of the aspects is the ability for the company to start buying back shares, because at this substantial discount to NAV, it makes absolute sense. But again, obviously, we've now got the relevant authorities in place, but it's then the liquidity question, which is one of the aspects under deliberation. Absolutely, there's value, and absolutely there's value for management to also start acquiring shares. Just on that, however, just to note and just a reminder that the management team, including myself, actually acquired shares in Grit from day one. We were never gifted shares, so we own a substantial portion of the company. And we have gearing facilities off the back of that. With the reduction in share price, we have obviously had to top up our specific facilities with the banks. So whilst we might not look like on paper we're buying up shares, we're still putting in substantial amounts of our own cash into our own shares investment into Grit from a loan to value perspective from our financiers. But absolutely, it is a great opportunity, because furthermore, what we're seeing is that we are seeing, and something Monica mentioned earlier, the valuations that you see today, which is obviously pushing up this LTV to 53%, are really, really, really conservative valuations. The valuers have taken a very conservative approach, remembering that unlike some of our shareholders are used to investing in South African REITs, unlike South African REITs, we have to have 100% of our portfolio independently valued annually. So these are not directors' valuations that you see there. We have some raised disputes with valuers, but it's a very conservative valuation. And that's why when we talk about valuation recovery, we do see in the medium term some trajectory. So absolutely, there's an opportunity. And at this level, there is a huge opportunity as a discount to NAV. So, and I think, Darren, I actually saw another question that was raised at the same time, is the shares actually being sold in the market, and there seems to be continuous sales in the market, which is obviously reducing the share price. Maybe, Darren, I can just ask you to touch on that specifically on our Mauritian register, whereby it isn't institutions selling, it's small retail clients, and it is on such low liquidity that it's dropping share price at the moment. So, Darren, maybe you just want to touch on that, because I saw that question, so I thought I would just join them.
Absolutely. No, it's a good idea to join them. So I think just to remember, our shares are fully fungible across both lines, both the Mauritian line and the UK line. So they are fully fungible and therefore should represent the trading dynamics in both lines should be represented in the price ultimately. So what we have encountered is that in Mauritius, because of this dollar shortage in the Mauritian market, given the lack of tourism and sort of the lack of the country generating dollars, we have seen anybody that's able to generate dollars has sought to do so. And as a result, the Grit share price seems to have been selling down on very limited retail volumes at what looks like any attempt to raise dollar liquidity. That obviously translates back into the London price, which has tended to sort of trade with a little bit of uncertainty. Obviously, we can't say, what people are going to do or not do. But what we certainly can say is that now that the results have been published, I think now that the uncertainty has potentially been cleared up with where we stand on both an LTV perspective and an operational perspective, we are engaging and we're continuing to market with various folks. You'll appreciate that in the UK, people do see limited liquidity and sort of a share price that doesn't go in the right direction, and that just makes them hesitant to get invested. We do continue to see strong interest from various folks. And often now that we've got the information out in the markets, we'd hope to engage, and we will be engaging quite extensively over the next couple of weeks with the markets, and hopefully that will give enough comfort for those potential buyers to step up and mop up some of that liquidity. So I think watch the space. We're doing everything we can do. We've reduced the listing structures. We've created the fungibility. We are being transparent on the assets. We're being transparent on what we are up to and what we can do. And obviously it's up to the market to price the valuation, which we believe is severely undervalued at current price. Maybe I can link to this question, Bronwyn. I think there's maybe a little bit of confusion still from what I can see on some of the questions about what exactly is the hotel's payment profiles currently. So maybe if we can go into a bit of detail about each one of our three operators, who they pay, are they paying, are they current, and what have they caught up? And if they haven't caught up, when are they going to catch up by?
Yeah, so thanks, Darren. And I think this is really important because it's quite a large portion of the portfolio. And we've done a big job as management managing these hotel operators. Obviously, they saw some very, very difficult times in their business, which they're obviously trying to navigate. So I think just to sum up, that Lux are current on all lease commitments. So we own the Lux Hotel, Tamasa Resort, including the collection of deferred rentals from 2020. So, we've done an exceptional job with Lux, and Lux have been really, really good partners for us. The Beachcomber Group, we see rentals resuming in full and have seen from the 1st of October of this year, and that has been fully committed. And the deferrals for the Beachcomber Group will be collected over the next 48 months up to December 2025. Neither groups were given rental remissions, but again, these were cash flow deferrals. Club Med resumes trading on the 5th of December, and we see all rental payments resuming in full. We had granted lease concessions from the 1st of January for Club Med, and those lease concessions, as I said, were in the context of the hospitality were not as material as what our Beachcomber and Lux exposure are, but the Senegal asset Club Med resumes in full from the 1st of December this year. So whilst it's been difficult from a cash flow perspective, and again, how has this impacted on our balance sheet? We've had to increase our gearing levels to help with liquidity. But as we see now going into the next 12-18 months, we see this resuming as per how we have seen pre-COVID.
Yeah, and I think just to add, Bronwyn, I think it's obviously Beachcomber is our largest tenant in that space. So I think, as we've said, that 50% will be collected over a 48-month period. So it won't come all in one go, but I think we are seeing the recovery phase, and we're seeing this globally. So we're quite hopeful that this current phase is indicative of the trend. We will get to the hospitals question shortly, but I think just before we get to that, I think, can we just go back to transactions in the market generally? So post fiscal year end, are we seeing activity in the market, specifically in office and retail? Obviously we have indicated the potential sales of some of our assets, specifically ANFA, and we're obviously in talk with others, but Bronwyn, some commentary or Leon, commentary around activity in the market, and obviously understanding it's Africa and is less liquid than Europe, but what are we seeing?
Yeah, so I mean, Leon, I don't know if you want to touch on that question, but I'm happy to start it. I think, again, it is less liquid. So the concept of asset recycling becomes more of a challenge for an Africa-run business. Quite honestly, sort of in the last couple of months, the actual sort of movement of assets and recycling of assets and transactional sort of updates in the market have been little. We have seen some movement in Morocco. Again, previously mentioned that REITs had been promulgated there, so we're still seeing activity. We're actually seeing a number of new businesses listing as REITs in Morocco, so there's been some trading activity around that. And we are seeing some stabilization around offices. And again, interesting enough, whilst Mozambique might be a complicated territory, our offices have actually been very, very resilient. And very much not the trajectory that you might have seen in people wanting to reduce office space because of COVID and work from home. We haven't seen those same anomalies in Africa. So for us, again, Africa becomes really, really difficult from a benchmarking perspective because there isn't a lot of liquidity in market activity, but we do see small tracks of it happening. And we think now sort of post-COVID and guys wanting to access growth markets, we still stay true that Africa is the prominent growth market to be invested in. And our asset classes and tenants are still very, very strong for the future. So we probably will see a little bit more activity going on in the market. So Leon, I don't know if there's anything else you want to add on that.
I think just in terms of deal flow, what we are seeing is specifically in the industrial space, there's a lot of deal flow in terms of logistics centers, warehousing, where there seems to be a very high demand. And then one other key area is data centers, with the actual focus now on data centers in Africa. Ria is actually about to hand over one of the first data centers that they've built, and there seems to be a significant demand for more product of that nature. And these are a relatively new asset class to ourselves, although we do have quite experience within the team on them. The reality is they are very resilient asset bases and something that we do want to look at as a group. The other item which we've seen significant growth in and requests for product is in terms of the corporate accommodation, specifically requests coming out of the US Embassy for these high security and very bespoke buildings that come with very significant lease periods of over 10 years and very good lease rates as well.
And maybe, Leon, between our partner Greer and ourselves, we've got a very good trajectory with this corporate accommodation and American Embassy. So currently under the portfolio, we own the Mozambique, Maputo American Embassy residential compound. Greer has just delivered the Ethiopian one. I was on site quite recently in Kenya. They're just about to deliver the Kenyan American Embassy. So we've got a very, very good trajectory and track record with delivering this asset class.
Okay, Bronwyn, can we move over to healthcare strategy in general? So maybe just paint the vision for what the supply side constraints are on healthcare across the continent. Maybe touching on who would be our funding partners in that, and then ultimately what the first two assets would be that are earmarked to potentially go into a healthcare strategy, please.
Yeah, so thanks, Darren. I think what is really important is, again, the ability that Grit is multi-geographic, multi-asset classes, that, we have the ability to look at opportunities and sectors as they become relevant in markets. And that gives us flexibility. It gives us flexibility to reduce retail when it's not performing. It gives us flexibility to look at other asset classes. Now, I'm basically based, I'm currently sitting in Dubai, and there's a massive amount of interest. One, the importance of healthcare for emerging markets. The second aspect is the importance of growth, the importance of operators coming internationally into these emerging markets. These two particular opportunities that Darren mentioned are two specialist hospitals being built in Mauritius. They are backed by an international conglomerate out of India, being Artemis, on 15-year leases. And what it means for real estate is that it means the importance of being able to provide real estate that speaks to the needs of what's happening in emerging markets and growth markets. And these two healthcare opportunities, on the basis that we based as a team in Mauritius, have come about from exactly that. And the opportunity to expand this and use the ability to access DFI money, which is development money, which wants to see money flowing into development type assets like healthcare, is a really good strategic alliance. And that is what we have seen, is the ability to leverage off these type of asset classes that speak to the real estate that we have got. When you're looking at real estate, whether it's offices, whether it's corporate accommodation, the healthcare clip-on or link is really important. Over COVID, it's demonstrated how even more important it is in these African countries and emerging markets because of the lack thereof. So we have seen huge interest from international operators. Now, if Grit and Greer can provide the real estate arm of this and are secured by long-dated leases, international operators, hard currency transactions, government-supported transactions, it makes absolute sense for us to get involved in transactions of this nature. So this is how we see healthcare under the ambient of the Grit portfolio today.
And if I can add,
just to overlay, are sticking to our philosophy in terms of just the structures of the leases, just like our hospitality assets. These will be fixed leases in nature. With the operators, they're not going to be any variability to these leases. The same basis as we've done the hospitality assets in the past.
And I think just a final point to overlay is that these transactions probably only work best when you've got DFI funding with them. Right. So what we found in the Orbit transaction, and as we talk about industrial assets, the due diligence and the governance structures that come along with DFI funding are robust. In fact, they take a long time to get yourselves fully governance, fully audited. And so I think the whole structure is therefore a solution for Africa and healthcare needs. It needs to be done in the right way. But rest assured that these funding partners come along with strong governance structures and oversight. And I think demand the best in green buildings. They demand the best in sort of sustainability, and they demand the best of the overall longevity of structures.
And maybe Darren, to overlay that, and just a reminder to our audience, is that we obviously did the premium step up in the UK this year. So that overlays even further the governance practices of Grit. So the establishment of Grit and the UK listing was to create a governed gateway or bridge into Africa. and that is paramount to us. So the governance side of the premium segments, the governance side of the DFI money that follows GRIT is really, really key. So all of the extensive due diligence gets done for every single asset that we acquire.
Great. I think we're running out of time now, so we'll accelerate the last few questions. So Leon, a question about the timing around a corporate bond issuance or syndicated facility, please, and what the advantages might be of such a structure.
Yeah, so the timing we're looking to really close this out would be by the end of Q1 of next year. In terms of the size, it'll be the full amount of the debt. It's a fairly complicated structure to set up initially. So we are looking for a few alternatives in terms of the ability to secure the assets within that structure. The key focus for us is to try and maintain the same cost of funding, while at the same time getting a longer tenor of the debt, which is for us a far more important structure than necessarily having to reduce the interest rates, which obviously would be a benefit if we could get them reduced. But in the reality in today's market, it's unlikely to get a significant reduction in that cost of funding. But the importance is to have a very good debt strategy that can be enhanced and also assist in the growth of the portfolio into the future once we get through this COVID period.
Okay. Thank you, Leon. I think just to finalize, and I think there's a couple of questions which we'll sort of bucket into one. I think the overarching sort of messaging is, well, we have had some big losses as GRIT. When can we expect to see dividend resumption? And I think maybe just and we'll do the some of the other questions finally. But if you don't mind me, I'll start off by saying, GRIT's losses that it printed over the last couple of years have been non-cash items, which are these valuation moves, specifically in the retail segment, as well as in corporate accommodation. So in terms of losses, to the extent that valuation stabilize in a post-COVID world, those losses will cease. Operationally, the business has generated operational profits over the last 2 years despite COVID, but those operational profits have been offset by these valuation moves you've discussed. So to answer when will we stop seeing the losses? Well, as soon as the valuation starts stabilizing, and hopefully if valuations recover, you'll start seeing even stronger profit recovery. Linking to the question on dividends, well, I think that's exactly that. To the extent that we're not seeing further valuation declines, our LTV will stabilize and will start trending towards 45% as we collect the cash. And I think the board has been pretty emphatic that as soon as it sees long-term and meaningful momentum towards that 45%, it will resume dividends. So I think that's not much more to say beyond those two items. I think maybe we can also then I'll go back to the data center one. Just finally, there was a quick question on the disposal of ANFA last year. I think that was to settle CapEx on ANFA. So just if I can refer the question back to the RNS we put out at the time, is that they didn't raise any fresh cash last year at this part disposal of ANFA. It was used to settle capital commitments on the assets. Leon, I think the final one is on data centers. Just can we go through a little bit more about sort of data centers, what we're seeing there, and in theory, should we not be accelerating that opportunity, or maybe even Bronwyn, if you'd like to contribute to that as well.
Yeah, so I think at the moment, within the fairly short term, we do have sight on 3 specific assets. We've got a sight on a potential new asset in Nigeria, which is quite significant. Secondly, there's 2 opportunities that within the Ghana market and Kenya market, and these are very, very exciting proposals. However, they require a significant amount of funding, and the size of some of these data centers can trend up to north of $70 million in terms of construction costs. Obviously, that requires a large amount of funding, and with our balance sheet, we'd want to fund that with further equity rather than debt to ensure that the LTVs are stabilized. There's a bunch of alternatives we can look at in terms of co-ownership with these assets, where we get the benefit of actually being the manager of these assets and becoming fee generations together with a partner owner, or to actually drive that development through our development vehicle, which is Greer, which is probably the preferred option, but does require an additional amount of significant equity to go into these structures with the opportunities that have presented themselves. And
then, I think let's, thank you, Leon. I I suppose we've run out of time, folks. We will have access to the management through the upcoming roadshows. I think each of our teams will be reaching out to you individually, and if there are any questions, please feel free to contact ir@grit.group. But maybe I can hand over to Bronwyn for a final closing remark.
Thanks, Darren. And yeah, thank you, Leon, and thank you, Darren. And the questions that have come through, if we haven't got to some of them, as Darren had mentioned, we're happy to take them. If you can just drop a mail through to us and we'll deal with them individually. So just on behalf of all of us, I think it's been an interesting trajectory over the last couple of months, but we are quite positive about some of the initiatives that we've actually put into place, what we have seen under the underlying performance of the portfolio, the importance now of share price recovery, getting that closer to NAV. The recovery of NAV and dropping that loan to value becomes key, and then getting into a position where we're able to resume dividends, which is obviously critical to the business. So those are really, really key focus areas of the management team. And on behalf of myself and the board, we'd like to thank you for dialing in today, and we look forward to seeing some of you in person in the up and coming weeks, or having one-on-one discussions. But please reach out if you need to have any further discussions. So thank you for joining us today.